All right, we will get going. So good afternoon. My name is Josh Stripmatter, and I would like to welcome you to Stripmatter Wealth Smart Money webinar series. Thank you for joining us today. Our presentation today is titled Summary of Tax Provisions for 2024 and 2025, and will be presented by Brenda Young at Stovall, Grandey, and Allen, or SGA as they're known by. For those of you that don't know us, we are Stripmatter Wealth Management Group. We are a registered independent advisor located in downtown Fort Worth, Texas. Actually, we're just a little west of downtown now. We just moved. We specialize in investment management, financial planning, estate planning, and real estate investment. We also have been in business since 2007 and serve clients throughout the United States. A little bit of housekeeping before we get started. All of you have access to the chat feature. So if you have questions, please don't hesitate to type in those questions, and we'll be happy to answer those for you. Also, we'll be sending out a replay of today's webinar via email. So if you missed something, don't panic. You'll have the ability to watch this again. And you're welcome to forward this presentation and any of our presentations to your friends and family if you think it would be beneficial. Today's webinar is meant to be purely educational and not meant to be tax or legal advice. So please talk to a licensed professional before taking any action on the information presented. For more information, including key disclosures, please visit us at www.stripmatterwealth.com. Now let me introduce our speaker today. Brenda Young joined SGA in 1999 and became a partner in 2005. She supports SGA's practice with extensive experience providing audit services to financial institutions and tax services to clients in a variety of industries. She completed college after marriage and children, and thus exemplifies dedication and determination in everything she does. Brenda loves reading and is an avid sports fan. She is married and has 2 sons. So without further ado, I'm going to hand this over to Brenda. Welcome, Brenda.
Thank you.
Oh, and you know what? I was on the wrong slide. There you go. There's Brenda.
Okay.
And
How are y'all? Hope all of you are doing well. Okay. So our agenda today, I'm going to tell you just a little bit about the firm. We're going to discuss some of the key amounts and thresholds that are in effect for 24 and 25. We're going to talk about business loss limitations, itemized deductions, the beneficial ownership information, business expenses, capital gain considerations, and then some other items as time permits.
Brenda, I'm going to hand it off to you now, so I'll let you take over.
Okay, so can you not hear me?
I can hear you, just I hadn't stopped sharing, so I think you're good now.
Oh, okay. So a little bit about the firm. It was founded in 1972 by David Stovall and Wendell Grandey. Mr. Grandey retired at the end of 2017, and we lost him in 2024. Carol Allen joined the firm in 1983 and became a partner in 1995. As Josh said, I joined the firm in 1999 and became a partner in 2005. Mr. Stovall turned 91 this past year. So needless to say, I say semi-retired, but he still likes to come into the office, but the firm is managed by Carol and myself. A couple of years ago, we did relocate our offices. We're at 4055 International Plaza, Suite 510 in Fort Worth. The firm motto is, it's more than just numbers, it's year-round relationships. That's what our goal is. We strive to provide a high level of service because we want to maintain those relationships and let them grow. And we have several generations of families that we've been servicing really since inception of the firm. We're full service. We provide tax and audit work to a multitude of businesses and individuals. And you can learn more about our firm by going to our website, which is sga-cpas.com. So let's dig in and start with the key amounts and thresholds. So there's been some changes in the standard deduction. Married filing jointly is $29,200 for 2024. And then that's set to increase to $30,000 for 2025. Single filers, it's $14,600 for 24 and is set to increase to $15,000 for 2025. Head of household is $21,900 for 2024 and is set to increase to $22,500 for 2025. Married filing separately is $14,600 for 24, and then it's going to increase to $15,000 for 25. And then there are additional amounts for those that are 65 or older. For 24, for married filers, this is $1,550, and for unmarried filers, it's $1,950. These are set to increase for 25 to $1,600 for married filers and $2,000 for unmarried filers. And if the filer is also blind, then basically these amounts double. So for IRA contribution limits, if someone is under age 50, that was $7,000 for 24. If they're 50 or over, it is $8,000. And these limits are set to remain the same for 2025. The simple IRA plan limits is under 50 is 16,000 for 24, and then 50 and over is 19,500. These are set to increase by $500 in 2025. The 401k, 403b, and 457 plan limits. Under 50 is 23,000 for 24, and 50 and over is 30,500. And these are set to increase by $500 in 2025. There are some compensation limits associated with that. For 24, it's 345,000, and that's set to increase to 350,000 for 2025. Profit sharing plan and set limits. The contribution limit for 24 is 68,000, and it has the same compensation limit of 345,000. For 2025, this is set to increase to a contribution limit of 70,000, and then the compensation limit will increase to 350,000. And these are nice thresholds for you to keep into consideration, because as you have the ability, it's nice to be able to maximize these so that you reduce your taxable income in the current years. And the idea is that you put these back in a retirement account, and then when you after you retire, your income will be lower, so that then hopefully when you withdraw the funds and it becomes taxable, then you would pay less tax on that money. The Social Security wage threshold is $168,600 for 2024. And then for 25, it's gone up to $176,100. It seems to me like the last few years, they have continued to increase the amount of the increase each year. So, they may eventually get it to where it's a very high number. So the required minimum distribution age for retirement plans for those that reach 70 and a half before January 1st, 2020, then 70 and a half was when they had to start taking the required minimum distributions. For those that reach 72 prior to, after the 1/1/20, but before 1/1/23, they got to use the 72 age. And then for anyone that reaches 72 after 12/31/22, the required minimum distribution age is now 73. This is actually set per the Secure 2.0 Act, that this will actually increase to 75 beginning in 2033, which basically means people born in 1960 or later are going to now have a 75 required minimum distribution age. If y'all excuse me, I've had a little bit of upper respiratory, and so I'm going to try not to have coughing fits, but I may have to stop every once in a while to just get a drink to keep from coughing. So basically, with the first year, when you reach that the age that requires you to take required minimum distributions, you really have until April the 1st of the following year before you have to take that first required minimum distribution. But one thing you want to remember is that if you do that, then basically that first year, you're going to be doubling up on the amount of taxable income that you're going to have from these required minimum distributions, because you'll have your first required minimum distribution that you waited and took April the 1st. But then by the end of that same calendar year, you're going to have to take your second required minimum distribution. One thing that has been around for several years now, but I think a lot of people forget about it, is that you actually have the ability of using your required minimum distribution and make what they called a qualified charitable distribution, which basically would transfer by the trustee of your IRA directly to a qualified charity. This is limited to $100,000 per individual per year. And it's only available if the money is in an individual retirement account. Like, you cannot do this by taking money out of like a 401k or some other type of qualified plan. It has to be from an individual retirement account. When you do this qualified charitable distribution, that income, while it satisfies your required minimum distribution, it is not taxable income to you. And so therefore you wouldn't get a charitable deduction for it. For example, let's say you give $100,000 to, say, United Way, and you do it through a qualified charitable distribution. That satisfied your required minimum distribution from the IRS standpoint, but that $100,000 will not be included in your taxable income. Therefore, when you do your itemized deductions, you will not take a $100,000 contribution off for that contribution to United Way. And where this gets really beneficial is that there are several things that are triggers from a tax perspective based on what your income is. For example, like the taxability of Social Security income, or like the thresholds in determining whether you're subject to the net investment income tax. So by doing a charitable distribution like this, it reduces your income, which then maybe makes it where not as much of your Social Security will be taxable, or your income may not be to the level where you end up going into the threshold and you're subject to that additional 3.8% for the net investment income. So it's definitely something to consider. So one of the things that came about as part of the Tax Jobs and Cuts Act was there were some business loss limitations. These were temporarily suspended under the CARES Act, but they were reinstated in 2021. And basically what it is it limits the amount of losses from trade or business that can offset non-business income. So for 2024, this is limited to 610,000 for joint filers and 305,000 for all other filers. These amounts are set to increase in 2025 to 626,000 for joint filers and 313,000 for all other filers. Any losses in excess of these thresholds, they're carried forward to future years. So, for example, you have business losses of, say, 620,000 for a joint filer in 24. Well, 610 is all of that loss that they're going to be able to utilize. So the $10,000 will carry over to 2025. And then let's say in 2025, their losses without that carryover are only 600,000. So they're going to be able to utilize fully that $10,000 carryover in 2025. So there's tax planning opportunities regarding itemized deductions, and we've talked about this for the last several years. I think that based on what the current standard deductions are, there's a much lower percentage of people that actually get to itemize. But for those that do get to itemize, there are ways that you can structure those where it's actually more beneficial to you. So in my example, let's assume that there's a married couple, and they typically give charitable contributions of $30,000 annually, and their real estate taxes, say, are $12,000 annually. Well, this would actually, if they just pay their, each year by itself, they pay those, well, it would provide for them $40,000 in itemized deductions, which exceeds the standard deduction that's available. Because remember, as part of the Tax Jobs and Cuts Act, they did limit what they call the SALT deduction, which is basically state and local taxes. They limited that to $10,000 per return. So even though your real estate taxes are $12,000, you're only getting to deduct 10,000 of those in the current year. So if, given this scenario, let's say they had the ability of, in December of 24, they actually went ahead and what I call kind of prepaid their charitable contributions for 25 of the $30,000. Well, that would mean that in 24, they actually would have itemized deductions of $70,000 because they would have their normal 24 charitable contributions of 30,000, plus they would have the 30,000 they prepaid for 25, and then the $10,000 that they were able to deduct for their real estate taxes. And then in 2025, all they really have is their real estate taxes. Well, that's less than the standard deduction. So they would go ahead and take the $30,000 standard deduction in 25. Well, this basically, if you consider 24 and 25, then in total for those 2 years, they would get to take $100,000 off of their taxable income because they would have the 70,000 from the itemized deductions they took in 24, plus the 30,000 of the standard deduction for 25. If they didn't bunch their charitable contributions and did each year by itself, in total for those 2 years, they're only going to get to take $80,000. They're taking the 30,000 in charitable contributions plus the 10,000 allowable amount of their real estate taxes. So by bunching those contributions, if you consider both years together, they actually are reducing their net taxable income an additional $20,000. So that's definitely something to keep in mind. I understand sometimes financially you don't have the ability of actually prepaying those. But if you do, that's definitely a tax saving strategy. But one thing I would recommend, depending on the charitable organization, if you do that, I would make sure that they're aware of it, just because, from a planning standpoint, from their perspective, they may be, if you've been consistently giving so much a month and you give them all of this money at one time, they may still be anticipating from a cash flow perspective that they're going to get those monthly amounts, and it could put them in a little bit of a bind. So we talked about this last year. The Corporate Transparency Act that was enacted in 2021 basically mandated that millions of entities report their beneficial ownership information to the Financial Crimes Enforcement Network, which is referred to as FinCEN, beginning in 2024. So these are original requirements were that new entities created in 24 must file the report within 90 days of receiving their organization paperwork from the state that they're located in. And new entities created after 24 have to do this filing within 30 days of its creation. Existing entities, which were those entities that were created before 2024, had until January the 1st, 25 to make this filing. Well, there was some back and forth. There was an injunction, a temporary injunction that was put in place by the U.S. Court of Appeals on December the 3rd that basically, said, well, right now you don't have to. Then it was like sometime in between that and the 26th, they removed that temporary injunction and basically said, well, because of this delay, you now have until January the 13th of 2025 for those existing entities to file the reports. And then December the 26th, the U.S. Court of Appeals reinstated basically the temporary injunction. So that means that technically right now, companies are not required to file. However, they can choose to do so. And this remains in effect until they basically either eliminate completely the filing requirement or they remove the temporary injunction. We've kind of taken the position with our clients, we're leaving it up to them because our fear is if we wait and don't file and then they remove the temporary injunction, based on the earlier experience in December, they only increased that filing requirement by like 12 days. So we're fearful that if we wait and don't file until they potentially remove the temporary injunction, they may not really give us much of a window to actually meet their filing requirement. And, as this progresses and you're further into tax season, it could create a real time crunch. But we have been leaving that up to our each individual taxpayer to let us know what they want to do. And there are some exemptions. Some of the more prominent ones are large operating entities that employ more than 20 people in the US. And they had gross revenue greater than $5 million on their prior year's tax return and they're physically located in the US, they're not required to file this report. Publicly traded companies that have registered under Section 102 of the Sarbanes-Oxley Act are not required. And then they have 23 types of entities that are exempt. For instance, banks are exempt from having to file this requirement. Accounting firms that are registered with the PCAOB are exempt from having to file this report. The beneficial ownership information refers to identifying information about the individuals who directly or indirectly own or control a company. There's several software vendors that are out there that will assist in filing these reports as needed. However, you can go to FinCEN's website directly to file them, and that is boiefiling.fincen.gov. And that's what we have been utilizing to help our clients do that. Basically, the reporting companies are domestic reporting companies that include corporations, LLCs, and any other entity that's created by filing a document with the Secretary of State or any similar office of the U.S. There's also some foreign reporting companies if they've had to register with these same entities. The beneficial owner is those that exercise substantial control over the reporting company, or they own or control at least 25% of the reporting company's ownership interest. Substantial control could be like a senior officer, the president, the chief executive officer, and so forth. They basically would have the authority to appoint or remove certain officers or a majority of the directors of the reporting company. They're really kind of the important decision maker in any other form of substantial control. So let's say you have a company that has 4 owners that each own 25%. Potentially, if those owners are not involved in the day-to-day decision making, potentially in that respect, you would probably have 5 people that you're actually having to report as beneficial owners, because there would be the person that was involved in making the decisions, and then you would have the 4 owners. And the basic information is you've got to report those beneficial owners, their full names, their date of birth, what their address is. And then you have to also upload in this filing a copy of a picture ID, which for most we've been using their driver's license. So it's just something to not forget. And we've been trying to monitor it for our clients so that we can keep them abreast and make sure that anything that is required to be filed is filed by whatever due date they end up changing it to. There are some pretty hefty penalties for deliberately not complying with these requirements. I think, to me, one of 2 things is going to happen. Either they're going to make this a permanent and rule it's unlawful, or they will remove this temporary injunction. I would hope that if they make it a decision that it's unlawful for them to be collecting this, I would hope that that would also include a provision that requires them to remove the information from their database on any reports that have already been filed. So if they do that, there's really no risk on your part in going ahead and filing the report. But, I guess we'll just kind of a wait and see type thing. So some of the more common business expenses, we went through a period of time during the pandemic where business meals, if they were purchased directly from a restaurant, they were 100% deductible. But for the last 2 years, these have been back to just 50% deductible. Entertainment expenses are still not deductible. So let's say, for example, you take clients to a baseball game. The tickets to the baseball game are not going to be a valid business expense that's deductible. But if you feed them while you're at the baseball game, that would be considered a business meal, and you could deduct 50% of the cost of that. So we had 100% bonus depreciation for eligible property, but that expired in December of 2022. For 2024, this 100% has been reduced to 60% for 24 and 40% for 25. There are going to be further reductions until it's fully phased out as of the end of 2026. The standard mileage rate for business miles in 24 was 67 cents per mile. This increases to 70 cents per mile for 2025. So the next topic is capital gains. And basically, long-term capital gains are for those properties held greater than 12 months. And we have 3 different tax rates: 0%, 15%, or 20%, which is all dependent on the taxpayer's taxable income level. For 24, single filers or married filing separately who have income of $47,025 or below have 0% tax on long-term capital gains. For head of household filers, that is $63,000 or below, and married joint filers is $94,050 or below. The 15% applies to gains for single filers who have income from $47,026 to $518,900. Married filing separately is subject to the 15% if their income is from $47,026 to $291,850. Head of household filers is from $63,001 to $551,350, and then joint filers is from $94,051 to $583,750. So 20% would then apply to filers that actually exceed those 15% limits. For 25, there's some changes where the $47,025 for a single and married filing separately filers increases to $48,350 for the 0%. The head of household filers goes up to $64,750, and then married joint filers goes to $96,700. The 15% then starts at a dollar over that, and then for the single filers goes up to $533,400. The married filing separately goes up to the $300,025. Head of households go up to the $566,700, and then the married joint filers go up to the $600,050. And then again, the 20% limit applies to all of those that go over the 15. Proper planning can eliminate or lower the tax burden associated with capital gains. For example, if you have large capital gains, you should consider selling other capital assets that have capital losses, especially if those assets aren't expected to recover the cost. The worst scenario that you can have is to have large capital gains, say in year 24, and you don't have losses to offset them, and then in 25 you have large capital losses, because married filing jointly is limited to only a net of $3,000 to take off. You can offset gains, but you can't offset more than $3,000 if you end up in a net loss position. And so you certainly, if there's any way to avoid it, you don't want to pay the capital gains tax in say 1 year, and then the next year have a large loss that you're carrying over and only getting to take $3,000 a year. Another planning is to make sure that you hold those capital assets for, over the 12 months, because you want to be able to use the long-term capital gain rates, because short-term is basically taxed at the same as what your ordinary income is, which then is dependent on what your taxable income is, where you fall in those brackets. So remember, there's still an exclusion for the sale of your personal residence. You can exclude a gain up to $500,000 for married filing jointly, and $250,000 for all other filers. You just have to make sure that it was used as your principal residence for 2 out of the last 5 years. So now we're going to kind of talk about just some other items. With the Republicans in control of the House, Senate, and the White House, we honestly are anticipating that there will be some major changes in tax legislation in 2025. As we've discussed previously, there's numerous tax provisions that were part of the Tax Jobs and Cuts Act that are set to expire in 2025. Some of those are, the tax rates changed, and they're set to go back up to the pre-Tax Jobs and Cuts Act. So right now, the highest individual rate is 37%. That's set to increase to 39.6 beginning in 2026 if this isn't renewed. The standard deductions increased significantly under the Tax Jobs and Cuts Act, and those will actually revert back to the much lower amounts that are adjusted for inflation. Personal exemptions went away under the Tax Jobs and Cuts Act, and those would then come back if this isn't made permanent. Child tax credit currently is $2,000 per child. That will revert back to the pre-Tax Jobs and Cuts Act of $1,000 per child. Right now, there's also another credit for other dependents of $500, which basically there was no provision for other dependents under the rules before the Tax Jobs and Cuts Act, so that would just go away. Charitable contributions were increased up to a maximum of 60% of adjusted gross income. That would revert back to the 50%. The salt tax limitation of the $10,000, that would be removed. Another change that would happen is mortgage interest was limited to the first $750,000 of a mortgage under the Tax Jobs and Cuts Act, but that would go back to the $1 million if not they don't make it permanent or renew that. And then the other thing was home equity debt basically is not allowed currently for purposes unrelated to the property that secures the loan. And that would go back to the pre-Tax Jobs and Cuts Act, which would allow up to the first 100,000 being deductible. Miscellaneous expenses basically went away with the Tax Jobs and Cuts Act. And if not made permanent, that would go back to those that are over 2% of the adjusted gross income being allowable. One of the big things is if you have any income coming from pass-through entities, you're allowed now the 199A deduction, which is up to a maximum of 20% of what that income is that you get to take off before figuring your taxable income. That would go away. And then, of course, the business loss limitations that we discussed, that would also go away. So there's definitely a lot of things that we have the potential of seeing. I hope since a lot of these provisions were part of the tax legislation that passed when President Trump was in office before, I would think that they would be a top priority for them to make sure that either they are renewed or made permanent. But at this point, it's hard for us to know um, what they're going to do. I just hope that they can progress with the tax legislation changes and get those implemented and passed as early as possible, because it does become a big problem when it's like in fourth quarter, late third quarter or fourth quarter when these are passed, because if there's things that are going into effect immediately, it becomes a real struggle from the software vendors for them to be able to get tax software updated where we're ready for the filing season. So the annual gift tax exclusion was 18,024, and that goes up to 19,000 in 2025. And that's basically the amount that you can give any one person without having to file a gift tax return. So, if you're married, basically both you and your spouse could gift the same person in 25, 19,000, which would be a total of 38,000 without having to file a gift tax return. Another really big item is the lifetime estate and gift tax exemption. So that was 13.61 million per person in 24, and it increased to 13.99 million in 2025. So unless this is made permanent or renewed, it's actually set to go back to the pre-tax jobs and cuts act, which was 5 million plus adjustments for inflation, um, January 1, 26. So this is one where I think we'll be paying close attention to during 25, because I had been a little fearful if, say, the Democrats had retained control. There was always the possibility in my mind that they could actually go in, and even though these escalated amounts are set to expire at the end of 25, I felt like there was a possibility they could actually pass legislation that would take those away before the end of 25. I really don't think, since this was part of the tax package that President Trump did when he was in office before, I really don't think we have the risk of this going away before the end of 25, but it is something that I think we have to pay close attention to, because for those that have estates exceeding these dollar amounts, if they do not pass legislation where this is going to be either extended or made permanent, you really don't need to pass up the opportunity to potentially get this money out of your estate before the end of 25 when it's set to expire. So it's definitely going to take some planning to be able to do that. But you take for a married couple, that's almost $28 million that they could remove from their estate that would no longer be subject to estate tax, which is a huge tax amount. So it's definitely one that we're going to make sure that we pay close attention to. So Josh, I have a couple of other things that are not on the slide. Do you think that we should pause for questions, or do you want me to just continue?
Well, people can type in their questions in the chat if they have questions. So we can pause here, whatever you'd like to do.
Well, it's just I don't want to not leave time if there's any questions, because I know we're set. We only have 15 minutes left.
Yeah. Why don't you just keep going, and then if a question comes up, I'll ask the question.
Okay. So we talked about this last year. So another thing to consider is Roth conversions. And that's basically where you would transfer from an eligible retirement account, like a traditional IRA, a simple IRA, any of those. You could transfer those and do a Roth conversion. And they would be received by the taxpayer and rolled into the Roth within 60 days or transferred trustee to trustee. If the conversion is from a traditional IRA to that Roth IRA, and it's going to be the same trustee, the account owner can direct the trustee to just transfer the funds, or if the entire account is converted, the traditional IRA can then be redesignated as a Roth IRA. The conversion rules are that the amount of the distribution that would have been included in income if it were not converted to a Roth is included in income in the year of the conversion. Thus, any part of the conversion that's attributable to basis is not included in the income. The 10% penalty tax on distributions before age 59 and a half doesn't apply. The converted amount is treated the same as a regular Roth IRA contribution, in that once the 5-year period rule is met, the converted amount can be withdrawn tax and penalty free regardless of the taxpayer's age. A simple IRA will qualify for conversion only if a 2-year period has elapsed since the taxpayer first participated in any simple IRA of an employer. Taxpayers age 72 or older cannot avoid the required minimum distribution for the year by converting an eligible retirement plan to a Roth IRA. Once the 5-year period has expired, taxpayers can withdraw conversion amounts, but not the earnings, without penalty regardless of their age. If this is something that you've considered in the past, now might be the time to consider doing this. If your retirement accounts are in the stock market, I know you want to try to watch that and all, but it definitely, for younger people, it's definitely a good thing to consider, because that's really huge in being able during your retirement years to withdraw that money and basically not have to worry about any taxes. The last thing that I was going to discuss is the 1099-K reporting. That is reporting for payment card transactions like debit cards, credit cards, Venmo, PayPal. So prior to 2023, this reporting was required only if the gross payments exceeded $20,000 and there were more than 200 transactions. So beginning in 22, they were set to start reporting anything over 600 and any number of transactions. But there was a lot of concern about that, because there's so many people that use Venmo and PayPal for really non-business type transactions. And so we were really concerned, that income was going to be reported to the IRS that really wasn't true business income. So in December the 23rd of 22, the IRS announced that they were going to treat 22 as a transition year, and not use the lower dollar amount. And they ended up like setting on a $5,000 threshold. And that is still in effect for 23 and 24. But even 5,000, there could potentially still be income. So I think the main thing is, if you get a 1099-K, you need to make sure that you provide that to your tax preparer, even if it is for income. that is really not taxable or business income. That way the tax preparer can make sure that it's shown properly on your tax return to maybe avoid future notices from the IRS about income that was reported to them that they don't see on your return. So that is the end of what I had ready to discuss. So if anybody has any questions, we'll be happy to take those now.
Awesome, Brenda, thank you very much.
Uh-huh.
A lot of stuff going on, right?
Well, and honestly, we were talking because we had some of our tax training Monday, and we got some more on Saturday. And it was a little bit of a struggle because there weren't a lot of changes for the 24 tax season. And for me finding, I guess, really meaningful continuing education to use, for training purposes for our people. And I told them, I said, I don't think that we'll have the struggle for 25. We may need to block off an entire week to discuss all the changes that may occur in 25.
Right. Yeah. Have to wait and see, right?
It is. Wish we had a crystal ball that was accurate, but we don't.
Yeah. I always remember back in 2016, all the tax changes that they talked about and that were being thrown around in the news, and very little of them came to pass. So,
Well, it's really no different with tax legislation, whether it's regulatory type things, like that banks deal with. I don't spend a whole lot of time on their initial proposals
mhm,
other than to just sort of get a gist of it. Um, because I've seen too many things that the final product really doesn't resemble the initial proposal at all.
right,
And so you have to, like I say, my hope is that they take into consideration the amount of time that will be needed to make software changes for these, for anything that's implemented that is going to affect the 25 tax season. Um, Luckily, a lot of these tax provisions that I think will either be extended or made permanent really don't have an effect until 26, which will actually help because they're good through the end of 25. But it becomes a real problem just from a time frame standpoint if they do something like in the last quarter and it's effective immediately. The software vendors just can't get their software updated, and it causes huge delays in the filing of returns.
yep, yep, I agree. Well, I don't see any questions, Brenda. So I want to thank you, as always, for your great information that you provided today, and we'll see you again next year.
Okay, thank you.
Thank you. Bye bye.